And we are back. This is Black Tower Radio. I'm your host, Jake Fox. You can hear us live on 1040 AM, 92.1 FM, WYSL in Rochester, New York. Also on worldnewsradio.today. That's worldnewsradio.today. Every Wednesday, 5 to 7 p.m. Eastern Time, right here on worldnewsradio.today. Every Wednesday, well, most Wednesdays, Wolf Richter of wolfstreet.com comes on at 6:30 p.m. Eastern and breaks down all of the economic goings-ons in the world. He is the publisher of wolfstreet.com, which is a fabulous site. It's really a great resource. It doesn't require a subscription. And I mean, he has great articles. He's being interviewed from coast to coast on various radio stations. He's been on the Kaiser Report a number of times, and we're lucky to have Wolf here as a regular guest. Thank you for coming on the show again, Wolf.
Well, thank you, Jake, for having me, and that was an awesome introduction.
I try to give great introductions. But it's true. It was all true. Starting off, or will lose the whole middle class. Gallup CEO. Economic recovery, but not for the invisible Americans.
Yeah, this was an article that Jim Clifton, the chairman and CEO of Gallup, wrote. He presides over these endless surveys of American consumers and businesses that go out on a daily basis, and that's what Gallup does. It just surveys not just in the United States, but internationally, just about everything that's out there. And so he has a very good feel of what American consumers and businesses, particularly small businesses, are dealing with. And so he got, I guess, a little upset when he keeps reading in the media about this recovery in the United States. And the way he put it is, and I quote now, it was even trumpeted on page 1 of the New York Times and the Financial Times last week. He said this idea of this recovery in the United States. And then he adds, I don't think it's true. So he then goes out to poo-poo this whole concept of the recovery and saying essentially that the media is not digging up the real data, and the media is just scratching the surface, the data that's been handed, but there's data that's beneath all this that shows that the recovery doesn't really exist for, especially not for a whole lot of Americans that didn't participate in some of the things that the Fed has done. So what he says is, and he's citing some data going from his surveys and from government databases. He says that the Americans who identified as middle class dropped from 61% 10 years ago to 51% today. So there's 10% fewer Americans who identify as middle class. Now that's a huge drop. So of 250 million adults, that's 25 million adults who were middle class and who now think they're no longer middle class. And that can be for a number of reasons, such as they used to make $65,000 a year. Now they lost their job. They get a new job. The new job pays $14 an hour. So now they're down to $28,000 a year, and their household income crashed. They're under incredible emotional stress. Their marriage is stressed. Everything is going to hell when this happens. And these people don't show up in the government statistics because they have a full-time job now, so they're fully employed. Their lives have gotten crushed, but they have a full-time job that makes a third of what it did before. And so as far as government is concerned, they're doing fine. And as far as reality is concerned, they're in real trouble. And there are a lot of these Americans out there. And he calls them the invisible Americans. They just don't show up in the data. And so unemployment rate looks good, but the drama, the tragedies behind that low unemployment rate is hidden, and he talks about the disastrous emotional toll that these kind of things cause in these families. And he says there's three things that we'll have to do that need to be worked on, or else we'll lose the whole middle class. And these three things are really crucial. And right now, there are about 48% of the people in America have full-time jobs. That's the lowest since 1983. And that's 1983 is when larger numbers of women started entering the job market. So the population, the working population grew dramatically at that time because of women coming into the workforce. And he also says that the number of publicly listed companies on the stock exchanges has been shrinking in the last few years, and it's actually cut in half over the last 20 years because of mergers and because of acquisitions and so forth. There are now fewer companies and about half as many companies publicly traded in the U.S. than there were before. And so companies, instead of investing in productive activities, they're buying each other out. Instead of hiring more people and putting money into research, they're buying back their own stocks. They're doing instead of doing actual engineering. And so companies have to focus again on growth rather than financial engineering. And his third point is small businesses, business startups. And there's always a death rate and a birth rate in small businesses. Now, you always have some of them that don't make it, that get shut down, while others are being born. And in the past, there was a large difference between those that were born and those that died, and there's 100,000 a year on average here, and positive. So the number of small businesses kept growing, and since the financial crisis, that relationship has changed. Now the number of small businesses out there is shrinking, and small business is the job creator. That's the entity that creates the most jobs, and so they're not creating as many jobs. Big businesses are into financial engineering, and so they're not creating the jobs that they should create. And so we have the situation where, we created 14 million jobs since the financial crisis, but we've had 15 million people enter the workforce. So it's not a good balance. And he says those three things are key right now. If we don't tackle them, if we don't get big companies to get away from financial engineering and focus on actual growth, if we don't help small businesses to thrive, then there won't be a middle class, because those are the job creators for the middle class, and and so he's very gloomy about that. Now, this doesn't show up in the media, and that's, I guess, why he's out there talking about it, because he wants to put some attention to this problem. And and then there's another issue there that's even worse when you think about it. In the census report that came out last week, we saw that the median household income was supposed to have gone up 2%, and but the report itself, the data, said that the median income for men was up 1.5%, and for women 2.7%. It's pretty small. And then the report showed a chart going back to the 1960s, and men today, adjusted for inflation, the median income is 4% below where it had been in 1974. And it's very difficult to run an economy where half of the people now, on an inflation-adjusted basis, make less than they used to in the 1970s. For women, it has turned around. Women have gained about 35% in median income. They're still way below men, but they have come a long way. But for men, it's been a disaster. And so when you put all this together, can you realize that there's a real threat to the middle class going on in the United States. And it's been going on for 10 years, and it's simply getting worse. It's not getting any better.
Well, I think the Gallup CEO is quite spot on in the situation. All of our government's attention is towards big business and big banks, and leaving, pretty much everything else out to dry. Not to mention there's a credit freeze going on right now, or a credit slowdown, whatever you want to call it. It's really hurting Main Street America, where, like he said, that's where the majority of the middle class creates their wealth. And a 10% drop in 10 years is astounding. I mean, we can't obviously maintain that pace, or like he said, we'll lose the whole middle class.
Yeah, and it's even more astounding because that percentage has been going up, or it should be going up. The middle class should be growing, not shrinking. Yeah, it should be 61% 10 years ago, and it should be 65% today, and it should be 70% 10 years from now. And but it's going the wrong way, and that's possibly one of maybe the only time in U.S. history that this has happened.
It's almost like a deliberate self-wound, and no one really cares about it. It's really, we're living in surreal times, for sure.
Yeah.
Second story here, recession watch. U.S. freight drops to worst level since 2010. Excess of capacity crushes rates. Overall shipment volumes are persistently weak.
We watch freight because it gives us one of the best thermometers into the goods-producing economy. And, the service economy has been doing okay. It's pretty well. The service economy includes healthcare and includes finance. And we know finance has been coddled by the Fed, and they've been hogging an ever larger part of GDP. And we know healthcare, with all the pricing scandals and all these things, healthcare is cannibalizing ever more of the U.S. economy. And there's some congressional attention and investigations going on right now on this, but they're not going to do much. I mean, the pharmaceutical industry is one of the largest contributors to Congress, and so there's going to be some posturing, but nothing is going to happen. So the big pharma and the other elements of the healthcare industry, they're going to charge for higher prices, whether it's insurance companies or whoever, for what is essentially something that every American really needs from time to time. And so this is part of the service economy. And they've been doing well. When you think about the wholesale business, 12% of the entire merchandise in the wholesale business of the United States is pharmaceutical products in dollar terms. Yeah, that's how big pharma is starting to monopolize consumer spending. Now 12% of wholesale is pharmaceutical products, and it's not because Americans are buying so much. It's because the prices have been checked to such an extent. And so now we go to the goods producing economy, where shipment is really the key, and there we can see the problems in the economy. We now got the freight index for August, and the freight index covers shipments by trucks, by railroads, by barge, air freight within the United States, and it dropped again in August, and that was the worst August since 2010. And I don't know how you can argue with this. I mean, there used to be this feeling that every year we're going to get a little bit better. And it was the case, 2011, 2012, 2013, 2014. Each year was better than the other. And now 2015 was the turnaround. And now in 2016, 2016, we're back to 2010. This is how much the shipments have dropped. And this is in volume terms, not in dollar terms. And the particular, and this doesn't count commodities, doesn't count oil and coal and wheat and other grains. This is product for consumers. This is product for companies such as equipment and for the auto sector. So these are things that are that are being manufactured or imported, and it has nothing to do with the price, the oil price collapse, or the commodities issues we have. And now we find out that the railroads, the container traffic is way down. The container trailer traffic, they call it intermodal, is down 4.5% in August from a year ago. In terms of truckloads on the road, we have a decline in volume. We have a slight uptick in tonnage, but a decline in volume. And so we're seeing a continued decline of shipments in the goods-producing economy. And that's probably not news to people who've watched manufacturing, which has been in trouble in the United States for a year and a half. We now have another issue that causes that decline. We have ballooning inventories, and that started in 2014, and we've been warning about it since then. And you have over-optimistic companies believing in the Kool-Aid the Fed has been handing out. They're ordering like crazy. The sales go down. Sales have been declining. And so the inventories are piling up for a year, year and a half. And so suddenly these companies realize, we've got to do something about these inventories. They're getting out of hand, so they're cutting back the orders. And when they cut back the orders, it shows up in the shipments. And a month later, 2 months later, the shipments go down. And that's what we've been seeing for a year and a half, And this inventory correction just started 4 months ago. So this is going to drag out a lot longer. The inventory to sales ratio in the United States, a key measure how fast merchandise sells, is back where it was after Lehman went bankrupt. So this is how bad it is. And so now these companies are cutting their orders, and we'll see more of these shipment declines. Now, I have another data bit just today that production in the auto sector in August hit another record for August, and auto sales has been slowing down. So dealer lots are already filling up with inventory. Now, this new production is going to hit these dealer lots. Sales are so-so. So we'll have another contribution to that inventory debacle, and pretty soon, dealers are going to have to stop ordering, and that will ricochet through the auto sector, and there'll probably be some plant closing and other things to try to bring production down. So this is an issue. When we look at freight, we're starting to see how it weaves into other parts of the economy. And right now, freight is telling us we have a real problem in the goods-producing economy. It's not going away. It's going to get worse. And and we're particularly worried about the auto sector, which is the biggest manufacturing sector in the United States. And the production part has been booming. Sales has been booming until earlier this year. They've been declining been getting weaker, for a couple of months now. So this year probably won't be a record year. We'll be down. Last year was a record year. This year will be down. But they're producing like crazy. So this is going to be an issue. So when overproduction, it's declining sales. That's how recessions are made.
I was just going to say, we were talking about this last year, Wolf. I mean, this has been an ongoing issue. This isn't new to us, is it?
Yeah. I mean, these things are a little bit like watching paint dry. You see the first signs, and that's usually when we pick up the first signs, we start warning about it, because nobody else talks about it. And so, like the inventory situation, we started talking about it in early 2015, and people called us alarmists and whatnot, and it just kept getting worse and worse and worse. And now we're paying the price. We're now exactly what we warned of is happening, that companies are cutting back their orders. And there's something called an inventory recession, and this is what we're going to run into. If the auto sector seriously cuts back production. That would mean layoff on the producing side. That would mean plant closures. That means that their supply chain is going to get hit. That has big significance all the way, and then the supply chain goes overseas, so it has impacts overseas. So this is not an easy thing to sort of brush off. This is this is sort of like a maze of relationships that are starting to be impacted.
Wolf Richter of wolfstreet.com. Go to wolfstreet.com for, just precise economic analysis in plain language. It's not, it's not the jargon that you don't understand, the economic jargon. It's in, like I said, in plain language. Really poignant, relevant stories. Things you should consider before investing, trends. He's got correspondents all around the world, Asia, Europe, North America, all the hot spots in the world economy right now. Wolf's got it all covered. 1 million hits a month on his website. He's doing interviews all over the place, coast to coast. Wolf's successful for a reason. It's because he knows what he's talking about. Thank you again, Wolf, for coming on the show today, and hope to talk to you soon.
Thank you, Jake. Looking forward to it.
Thanks, Wolf. So join us next week as we talk with Paul Craig Roberts. Paul Craig Roberts, the co-creator of Reaganomics, former editor of the Wall Street Journal. Anyone listening to the show is well aware of Paul Craig Roberts and his ideas. So we'll be going live next week, Wednesday from 5 to 7 p.m. Eastern Time, right here on worldnewsradio.today with Paul Craig Roberts. We'll also have Colonel Anthony Schaefer bringing some political analysis, or some geopolitical analysis. And we'll have Wolf Richter back on again for some economic analysis. So we got a stacked show next week, right here on worldnewsradio.today. Black Towel Radio. I'm your host, Jake Fox. Now stay tuned for another episode of Project Censored. Keep it right here on worldnewsradio.today. Good night, everybody.